Self-Wealth Live, we call it Technical Analysis Edition, as we've been doing. First and foremost, I just want to welcome my co-host here, which is Jason McIntosh here from Motion Trader. I just want to quickly say something about last week. We apologise for not turning up last week. We had a personal circumstance happen. But we'll, once again, obviously we'll endeavour to be here at 12 o'clock on Tuesdays, every Tuesday for the next 10 weeks as well. All right. So without further ado, Jason, we are talking about systems today and how to build systems. How are you, Jason?
Yeah, hi Roger. Yeah, no, really good to be back. Yeah, shame we missed last week, but hopefully we can make a do for that this week. And yeah, look, of course, before we start, we just got to show the usual disclaimer, all the important information that goes along with that. So here we are. We've got there's two parts to it. Just to quickly pause and read through. The first one talks about me. I'm from Motion Trader. I'm not from Self-Wealth. So I'm operating under a license provided by Chartreux Wealth Management. And you can see their AFSL number is 422409. And then below that, we've got all the self-wealth info. So yeah, always pay attention to these things. General advice, everything we say today is all general advice. Nothing's tailored to you or anything like that. It's all general. So you've got to do your own research and stuff. But with all that said, back over to you, Rog.
Thanks, Jason. Now, obviously, systems, it's an important thing. Last week or the previous episodes, we talked about psychology. I think you've got to get the psychology right before we get systems, right? So if you haven't seen the psychology or the mindset video we did around trading, then check out that one after this as well. All right. But the next thing I think is important, as always, when we come to sort of technical analysis of trading, it's having a good system behind you. Now, I guess my first question for you, Jason, is look, what is a trading system? What's a trading system? Can anyone build one out?
Yeah, look, I think a lot of people think they hear the word system, think, look, that sounds pretty complicated. Maybe that's a little bit beyond me. Maybe, I don't know, a trading system might be a bit too much. Maybe it involves computers and codes and all sorts of complicated things. But the thing is, it's not, a trading system really doesn't need to be rocket science. It doesn't have to be anything which is just over the top complicated. In its simplest form, a trading system really is it's just a collection of rules which you bring together, and it's that bringing together of that collection of rules that forms the systems. And now you need the various components to a system, and we're going to go through some of those. We're going to go through 5 of those key components in a little bit. And that's once you get those components and you can answer the questions that come with those components, then anyone, I think, really anyone can build their own trading system. As I say, it's not rocket science, and it's just the whole process of thinking systematically, I think, can give anyone potentially an edge in the market. And I think back, when did I first start thinking systematically? And the first time I really remember doing it was I was around year 12 at school. So it was 1987. And so I was doing economics and we're talking about money and economy and stuff. I'm always thinking, how can I make some money? And I didn't have very much, I had about $50 in the bank. And I started reading about a betting system for the dogs of all things. And nothing fancy. It all had to do with what box the dog was going to jump from and the movement and the odds in the lead up to the jump. And so look, really, really simplistic. And look, I only ended up sticking at it for 2-3 weeks before I'd done my $20 tab account. And but the important part of all this was that for the first time I was thinking systematically. It wasn't a case of this subjective reading of a form guide going, oh look, I'll have a go at that one. It was, well, if this happens and then that happens, we'll put your money on this dog. And so it was systematic. It took away the subjectivity, it took away the emotion, and it didn't work, but it opened a doorway, which I then continued down over the years to come, and brings me to where I am now, where I'm very systematic in how I approach markets and how I do a lot of things. And yeah, it's all about finding a way to get repeatable success. And I think you get repeatable success when you systemize. That's what all the great traders talk about. They talk about how they follow, they've got a process, they've got rules, and they follow that. It's not this ad hoc, oh, I like a bit of this, I like a bit of that. It's, follow this process, follow this sequence of rules, which forms your system, and that gives you the potential to do well in the markets over time.
Yeah, and I think you use a good analogy there with dogs and the races, because I'm sure even if you use a good system, you could still pick dog of stocks, right? So, but the idea is, I don't think there's anything in the world that's successful over a long period of time without good systems. It doesn't matter whether you're trading or whether you're, in a factory, and everything runs long term over systems, right? Having systems in place, and trading is no different, right? So where do you think people go wrong, Jason, in systems?
Yeah, good question, Raj. Look, I think there are a couple of areas where people go wrong. I think the first one is that they make things too complicated. And we've all seen those pictures of a trading floor, or of a trader sitting in front of 3 or 4 screens, and there's indicators everywhere, there's graphs, there's lines. Don't know where to look. I've been doing this for a long time, and I see some of these screens and go, "What on earth is going on?" It's and I think a lot of at home everyday people who do other jobs, they see these screens. Like the professional trader looking at it, there could be a good reason there's all these screens, but your normal person who's doing other things, they look at this and think, well, okay, I've got to do this too, and then the whole thing becomes really complicated. And complicated things tend to break down after, sometimes after only a short period of time. So I like to keep things simple, not to overcomplicate it. You only need maybe for your entries, you might only need 2 or 3 rules which come together to create a buying system. You don't need 30 indicators and all the other stuff. And I think the other area where people get into trouble is that they focus too much, and some people focus almost solely on only one component of a system, and that's when to buy. It's like, you just think about all the emails we get and the websites we go to. It's almost always focused on when to buy, what to buy. It's not, but there's a lot more to it. It's like, what about your risk management? What about your selling? What about how much you're putting in each stock? None of that's really spoken about, and I think that means a lot of people, they just focus on when to buy. And this is a mistake, because buying is important. There's no doubt about that. Buying's important, but it's only one part of a complete system. And you think about like buying is a bit like a plane's engine. So you can have the biggest, most powerful engine, but unless you got the wings and the tail and the rudder and the people to fly it, this big great engine is not going to do you too much. So it's the same with your buying strategy. It's great to have this excellent buying strategy, but you've got to have all the supporting mechanisms to make that buying strategy hopefully pay you nicely over time.
Yeah, and I mean, obviously, I always love the fact that you can always bring that towards like it's exactly like flying a plane, in one sense, that you need to have, not only from last week we were talking about having a checklist to get the plane off the ground, but what about that checklist to get the plane off, back landing and making sure we're safe there. And I sometimes ponder people that just just invest based on maybe emails that go out, but they never get told, right, when is the right time to exit. Or even if you're a long-term holder, are they going to have the heart to be able to see their asset lose 50%, 25% in the hope that they might come back years from now, or they're going to just close it out because they never had a system in place. They were just told that it was a good pick, and they never really had a system in place if they wanted to become active, or they wanted to be, get into share trading, right? Unfortunately, a lot of people get burnt because they never really had a proper system, whether they were a long-term holder or whether they want to be more active in trading. if you didn't have a system in place, most of the time you're not gonna last in this game, right? So, but yeah. So what are the components of a successful trading system then, Jason?
Yeah, look, it's I look at a trading system a bit like like Lego. Like we all know Lego. Everyone's had a bit of Lego and played with some Lego. And a trading system, you can kind of look at it in the same sort of way. In that, when you're playing with Lego, you're connecting the blocks together to create something. And what you're doing with a trading system, you're connecting together various components to create a system. And so, like, look, let's just focus on buying, because that's what we've been speaking about. So like each like a buying, so your buying component could be like say you're using a moving average. That could be a Lego block, and you're going to combine that with a breakout. That's another Lego block. Clip them together. Then you're looking at some volume. Clip that on. So that's your block for when to buy, your component, your trading component for when to buy. And then you got another component which is about when to sell, and you're going to have various blocks you're going to clip together. Then you're going to clip them together again with your risk management and your position sizing, and all these blocks that come together form your system. So look, I like that Lego analogy of how you actually build a system up. It's not just about reading something about when to buy a particular stock. It's about bringing all these different pieces together to form a system. And the thing is, you've got to have all the components. You just can't have when to buy. It's a bit like building a Lego castle and only building the tower for the archers to stand in and shoot the arrows from. Like, what about all your defensive structures? What about the walls and the moat and the storerooms and the living quarters? So unless you build all the other things, your guys up the top shooting arrows, probably not going to work too well. So that's why you got to build out the whole thing. And I think it really comes down to comes down to 5 key areas. And now what we're going to go through now, we're just going to go through the 5 big blocks, that your 5 big questions you've got to answer to build together your system. So let me just share my screen with you. And so these things here that we're going to go through, these form the core blocks of how you build your system. So I'm not going to go through each of them in detail, because they're quite big areas on their own, but just briefly going through these components. So the first question you've got to ask yourself is, what am I trading? What stocks am I going to trade? Or am I trading something else? Am I trading currencies or metals, or what is it? And if I'm trading stocks, am I trading big stocks or small stocks, or am I trading ETFs? Or am I trading growth or value? What is it? There's no right or wrong answer. You kind of need to know what it is that you're focusing in on, because then that can affect how you answer the other questions that you need to go through to build your own trading system. And so once you work out, okay, I know what I'm going to trade, you go, well, look, how much am I going to invest, or how much am I going to risk on each trade? And so you need to know, to work out what your risk is, you need to know what your investment is. So the two come together. And like, you could be saying, well, look, okay, I'm going to have more. I'm going to risk $10,000 on big stocks and $5,000 on mid stocks and $2,000 on small stocks. Or it could be, I'm going to equally weight my portfolio, or I'm going to use a percentage of capital in each investment. Again, there's no right or wrong answer, but it's something you got to think through, and something you've got to actually put some good thought, like, how is this going to work? It's interesting when I think back to where I started in the dealing room. So this is back in the 1990s, and I think back around the room, and I think about how a lot of the traders would position size. And this is a professional. This is a high-end professional trading environment. And a lot of the traders were quite ad hoc in how they do their risk management. It'd be like, well, okay, I got high conviction on this idea, so I'll put 50. I'm going to risk 50,000 on it. And this idea, well, it's a bit in the middle. Maybe I'll risk 20,000, or something like that. And so it wasn't always scientific; it was subjective. So this is what we're trying to do by asking these questions. Because you don't want it to be subjective. You want it to be repeatable. And you want to be able to control risk in varying environments. So you've got to be able to say, look, this is how I'm going to decide how much to invest or risk in each stock. And then you've got to work out, well, look, what's my entry strategy? And we spoke a bit about this entry strategy earlier. It's like, you know, what are the rules? What am I doing? Am I using moving averages or breakouts? Am I using fundamentals? And, you know, is it a combination? Again, there's no right or wrong, but you've got to be able to say, you've got to be able to like write down, okay, if a stock meets these criteria, well then it's a buy. Anything else is really subjective, and it's probably not going to lead to consistent outperformance over time. Now, the next two are really interesting. They're combined, but they're different. And so the first, of course, is like, you know, when do you decide, when are you going to cut a losing trade? This is such an important question, and I think for many people it is an afterthought. And it's so many people I see, they just like a stock, well, they'll buy a stock, it's down 20%, it's down 30%, and they don't sell. It's this whole loss aversion. This all comes into mindset, which we spoke about a couple of weeks ago. It's like, you know, I'm down 30% of stock. What do I do? And a lot of people say, well, I'm going to hold. I'm going to wait for it to come back and then I'll sell, or I'm going to double up. And it's not really, that's not a strategy. You can't, well, I guess you could make that a rule. If the stock's down 30%, I'm going to double up, or I'm going to shut my eyes and hope for the best. But it's, you know, it's not really the sort of like rule you want to be writing down. It's not good. You can't backtest that sort of rule either. And we'll get to that a little bit later on. So you've got to know when you're going to rule off on a stock that's not working. And it's a bit like driving a car. Like, say you're going somewhere in your car and you take a wrong turn. So what do? Do you look at the map, do you stop, look at the map and turn around? Or do you just keep going down the wrong road and go, well, I kind of hope that, you know, somewhere or another the roads will all link up and I'll get back to where I wanted to go? Now, of course, you don't do that. But when we come to the stock market, a lot of people kind of do that with their stocks which aren't working. They keep going down the wrong road and hope that it will all kind of work out in the end. That's not a strategy. It's not really a rule. So you've got to know, you've got to have these clear-cut points. And you make it clinical rather than subjective. And the last one, and this is another one which trips up a lot of people. They don't really think about it. It's like, when do you sell a stock that's making you money? And I think this is the key to being able to have a strong portfolio over time. It's like, when do you sell your winners? Like, people have spent so much time, when do I buy the best stocks? Or no, what are the best stocks to buy? But it's actually, when do you sell the best stocks, which matters the most, because that's when you make your money. And I think that I've seen so many people over time, Roger, they get a stock which, say it goes up 100% and there's no strategy for selling, and then the stock peaks and it starts to come down again. Then they're up 70%, they're up 50%. Too late to sell now, they'll tell themselves. Then it's up 20%. Next thing you know, it's below where they bought it. So they didn't have a strategy to sell. So they wrote a great trade up, wrote it all the way back down. So you've got to have that exit strategy. It's a really, it's a really important thing. And so this is all these things here, all these questions, these 5 questions. It's a real mechanical way of thinking. And I think if you can adopt this sort of rules-based mindset, then I think you really do open up the potential of being able to make a lot of money from the market over time. So it doesn't mean every trade's going to be a winner. There'll be plenty of losers, but you've got strategies, you've got rules for that. It's part of the process. And then you know what to do when you're making money. You've got rules. You're just taking away the guesswork. You're taking away the gut feel, subjectivity. Reading blogs, getting people's opinions on what to do. Get rid of all that, and you just follow your process. Mechanical, rules-based, systemized. I think it's a very hard process to beat.
Yeah, no, it's good tips there, Jason. Look, I can attest to just recently having a stock go up by about 50%, and then not marking or not following my trailing stop when I should have. I just didn't, and then I should have got out, and I would have got out with a better profit had I have actually followed my trailing stop. And I just realised that, oh, hang on, I didn't follow my rule, and I think this once again comes down to a system. But I've got a hack to get around that next time, which I could probably share with the guys later on. If you share a trading view chart later on, Jason, I'll share what I do now to try and avoid me missing out on these trailing stops if you haven't got an automated system, right? So yeah, all right, no worries. So okay, we talked about the successful components. Before we get on to my next question, guys, just don't forget, remember to like. If you like this kind of content, please like and subscribe to our channel so you can get notification whenever we do go live. It'll just help us out quite a lot, and help us feel good as well. Yeah, so how do we test and optimize our system, Jason? How do we, now we've got sort of established some components, how do we test and optimize?
Yeah, look, it's really it's really interesting, the testing phase. And this is something which it took me a while. It's like I'd always like I'd look at a chart and think, well, look, how's it? I'd look at it maybe over the last year or so and try and work out like where the moving averages were and what might have happened. But the longer you're in this game and the more you start to understand it, you get to realize that you really need to test your strategies and test them over as long a period of time as you can. So this is where you can get testing software. So I use specialized backtesting software, so I can come up with my trading rules and I can program them in, and I can put the historic data through it, and I can see how those rules have performed over time. And this is where it's really important to have two good things. You want to have good software, and you also want to have good data. And you think, well, share price data, how hard can that be? You just get the history. But the thing is, like, there's always a lot of corporate actions within a share price history. So, for instance, a share price reconstruction. So there might be a stock, for example, say a stock's trading at 10 cents and they do a 10-for-1 reconstruction. So for every 10 shares you have, you swap them and you get one share. So the 10-cent share becomes a $1 share. So if you're looking at unadjusted price data, you'll be seeing this stock's trading long, at 7 cents, 8 cents, 10 cents, 9 cents, $1. And you go, wow, that stock's up tenfold. But it's actually not. They've just reconstructed the share base.
Yeah.
And so if you're putting unadjusted data through your system software, you might think, look, I'm onto something really good here, but you're actually not. So you've got to make sure, if you don't do back testing, make sure you get data which is adjusted for capital returns and reconstructions and these type of corporate actions. And I use some trading software. So I'll show you what I do, and we'll actually backtest. I'll show you how I do some backtesting. We just backtest a really simple strategy. So let me show you, because this is great. This is so much better than trial and error. So in the old days, trial and error was, and it's the way a lot of people will trade now. Trial and error. I'll see whether this process works. But the problem with trial and error is it take a long time to get your answers. If you can get your trading rules and you can test those rules, even if you don't have software like I've got, even just going through a lot of charts and just trying to put it together, it can really help, even give you the confidence to stick to a process when it's not working, because market conditions won't be suitable to whatever you do all the time. So this is this software I use. It's called Trading Blocks. It's professional trading software for testing and building strategies. So let me just talk this through with you. So what we've got here. So we're talking about those five questions earlier on. So in here, I've got I'm answering the which stocks to trade. So I'm trading the entire ASX, excluding ETFs and LICs. So that answers that question. And then how much to invest in each trade? Well, I've put in here $1,000 for this example, using $1,000 per trade. What will be the entry strategy? Well, I'm using a moving average crossover. I'm using a 50-day moving average, and the long moving average is a 100-day moving average. So when the 50-day gets above the 100, that'll be a buy signal. And when the 50-day goes below the 100, it'll be a sell signal. And then that also ties in with when do I cut a losing trade and when do I cut a profitable trade. It's when the moving averages cross. So as I say, it's a very simple system, but it's an interesting one because it's a moving average crossover, which is what probably a lot of people would understand and maybe would consider using themselves. So let's run this. And also I'm doing this. The start date's 2019. Could go back further, but it will take too long to run the simulation. And I've put in $50,000 of capital. So this is going to test what a $50,000 capital base what would happen if we followed a 50 and 100-day moving average crossover system. As you can see, there's all sorts of stuffs and parameters you can add in. We're not doing any of that. We're keeping this super simple for a couple of quick simulations. So this is what I do each day. The ASX data comes in at the close of day. I'll download that and then I'll run it through the system. And down here, you can see these are my motion trader systems that I run and send out to members. I get all the signals for. This is my own system, which is basically the motion trader system with a small adjustment for exits. And here we go. So the system's almost run, and this is what happens when you follow that moving average process. Doesn't look very good, does it? You can see that. Well, this is the COVID crash, the COVID recovery, and since then it's just been a disaster. So on first glance, this strategy doesn't look very good. Now, another thing I do when I backtest a strategy is I will come along and I'll look at the individual charts, the individual stocks. And so what makes up that equity curve we just saw? And I'm going to sort them by profitability from best to worst. So let's just do that. And when I scroll down, I can see, look, the second best trade was this stock here, Jindalee Resources. It's made $6,400, so it's up a bit over 600%. Well, that's good. I'm happy with that. So let's see, how did that work out? And this is sort of what I was expecting to see. So it starts off as a not a highly traded stock, but the moving averages cross, give a signal, and we can scroll this across, and you can see it continues to move up. The moving averages keep rising, so it stays with the stock. Then the moving averages cross, it starts to decline, and that's the exit point. Okay, so that's all good. So what's going wrong with this strategy? So what I'll do now is I'll scroll up and look at the ones which aren't working, and I cast my eye down here. I can see all these 1 and 2 cent stocks. So at the losing end, there's a stack of these small stocks. So let's just click on this one here, Discovery Alaska. And so this is interesting. I can see this. So the moving averages have crossed, and these are small stocks, so they're volatile. They jump all over the place. So it triggers an entry at 9 cents, and then by the time the exit's triggered, it's down at 3 cents. So that's like, you're wiping out 80% of your capital or something in that particular stock. So I can look at this and go, okay, well, maybe these small stocks aren't a good thing to do. So what I can do, I can say, okay, let's adjust the strategy. Let's adjust the which stocks I'm going to trade category in my system. So this is here. This is where I can do this. So we're not going to get too caught up in any of the coding, but what I'm going to do, I'm going to add in a simple rule. Only buy stocks which are trading above 30 cents. So that's the only change I'm going to make. It's using all the same parameters as before, but it's only buying stocks which are greater than 30 cents in value. So let's just run this simulation again and see what we get this time around. See if we can do better than this last one. And so yeah, look, this backtesting, it's a fascinating way. I think you can learn more in an afternoon than you can learn in 2 years of trial and error. And if you can, look, if you've got the ability to backtest your strategies, it really can give you that head start and get you out of stuff which isn't working a whole lot quicker. And look at the difference this makes. This is so interesting. So from the strategy which was a complete fail, this has turned a $50,000 portfolio into a $90,000 portfolio in 4.5 years. The only difference between the last simulation was we've excluded those penny dreadfuls, and the whole thing works a lot better. It's given a 13% compound annual growth rate. The All Ordinaries over the same time frame is up. I think it was up 30%. This strategy has returned 80%. So done quite well. Let's quickly jump over and look at the stocks within the strategy. Let's order them by profit and loss again. Let's go to the losses first, and let's click on this one here, Optima. So you can see, well, look, it's this is producing this is one of the worst trades, but it's not like a 90% wipeout. It's 50%. It's not great, but there's something we could work on there probably. But triggers an entry, triggers an exit. That's all good. Let's go down the other end, and let's have a look at. So you can see the profits. So we've got like 600, 500%, 300%, a few 200%ers are in there. And that all seems to work out quite well. Here's an interesting one, Kogan. Have a quick look at Kogan. So this was one of the boom stocks during the COVID period. You can see how the market crashes during COVID, and then it rebounds. So this was one of the strongest stocks during that COVID rebound. And this is an interesting one, because this is the sort of stock I got emails from members of my Motion Trader service about during COVID. They'd say, look, the stock bottomed around $3, but you're not getting a moving average crossover till $7. That looks too late. Why can't you get into these stocks earlier? And well, look, you can. You could get into something like Kogan earlier, and I'll show you what we can do. Let's do one more back test, and let's do this, and let's get into Kogan earlier, because this is an interesting learning exercise on how one change can have an effect on other unexpected consequences, I think is the way to put this. So let's just change this. I'm going to use a 20-day moving average, and I'm going to use a 30-day moving average. And let's just run this. So all the crossovers are going to happen a little bit quicker. Roger, any idea how this is going to play out?
It'll allow you to actually enter in sooner, so you'll have a better cost price, I'm assuming, because the moving averages are gonna. I think you're using 50 to 100, right? Is that right?
Yes, we were using 50 and 100. Now we're using 20 and 30.
They're going to cross over sooner, so it'll probably give you a cheaper price to get into Kogan.
Yeah. So that's exactly what I'm looking for as well. And so I'm going to look at the equity curve first. Let's start with that. And it looks quite similar. It's quite similar to what we saw before. 50,000 turns into just short of 90,000. So it's a touch below, but it's pretty similar. Now let's jump in and have a look. Let's just have a look at how all this works. So I'm ordering by profit again. And here's Kogan. And yeah, so look at that. That did work. So anyone who thought let's use shorter moving averages, you're right. You get into these stocks early instead of getting in up here at $7.82. We're in at $5.89. So that's gonna make a difference to your profitability. So on the surface, you're thinking, yeah, look, let's use these shorter moving averages. But it's never that clear cut. You rarely get a free kick when you're trading in the markets. So let me show you the unintended consequence of doing this sort of stuff. And let's have a look at this stock here, Split IT. Now, the 20 and 30-day moving averages trigger an entry signal for Split IT, and then it's a short-lived rally. The moving averages crosses, comes back down, works out to about a 50% loss. Okay, so that's not so flash. When we go back to our if we look back at the 50 and the 100-day moving averages, well, actually, let's just quickly do that. I'm just going to quickly find SPT. So these are all the ASX stocks that we scroll down to. Stacks of stocks. This is why using computers is so good, because you can cover so much more ground. SP, where are we? Just a couple more down, and I can find, there it is. There's a stock, and it was in April 2022, which is back a little bit. Here's the same rise, which cost us 50% using 20 and 30 days. The longer moving averages never cross. It never creates a trade. So that's not to say that 50 and 100 days are better. It's just to say that if you're going to use shorter moving averages, the trade-off is you're going to have more false signals. Stocks like this are going to trigger, whereas the longer moving averages won't. And the other thing to note, which is interesting, is that look at the number of trades. So this is the 50 and the 100 day. It has 688 trades, whereas the 20 and 30 day moving averages have triggered more than 2,000 trades. So there's going to be a lot more activity. Again, it's not necessarily a bad thing. It's just something you've got to be aware of. And so look, it's just interesting how all this works. This is like building systems, building rules, understanding how it all comes together. And one of the things which a lot of now I see this a lot of times when I see promotions for people for businesses that sell systems. You look at some of those equity curves. So you remember the curves I was showing you for those 3 simple strategies we tested? They zigzag. They go up, they come down, they go up, and there's volatility within them. And I see some equity curves which are quite linear. They go up in this nice straight line. And whenever you see a curve like that, you've got to be highly suspicious, because backtesting is a really good tool for understanding your strategy, for finding what works, what doesn't, but it can also be misused in that it's also easy to do what we call curve fit. You curve fit a strategy around past data. So when you know the past, you can design the rules to suit the past. And of course, going into the future, we don't know the future, so we can't build the rules to suit the future. So when I design a system, I describe it a bit like having a loose fitting suit. So my systems aren't all nicely tailored and provide the perfect outcomes because I don't know the future. So a nice loose fitting suit, broad parameters, 50, 100-day moving averages, 70-day breakouts, wide trailing stops. Yeah, you get some more movement, some more volatility, but that's what the market is. Market's volatile. We're operating in an uncertain and volatile environment. So you've got to expect that. If you want smooth and linear, well, then you're looking at term deposits. It's just the way it is. And and backtesting is a terrific tool, but you've got to use it properly, and you can't just put in special rules to say, look, I don't want that stock in the portfolio because it makes my results look bad. So special rule to avoid that, because the knock-on effect is you'll probably knock out something else, and the whole system doesn't work anyway because it's all tailored around what we already know. It's what we don't know that's coming up. That's the trickier part, and I find that simple rules, simple processes, but complete processes that can answer those 5 questions, they're the ones that can potentially do really well over the medium to longer term.
Yeah, no, that's some really good information in there, Jason. I got a lot to absorb there for myself as well, right? I think some of the key points. Obviously, we might put the link to that software that you use. It's called Trading Block, right? You can probably Google it, I guess. We might put it in the description there, right? Because it's not part of our offering. Obviously, it's not something that you design. It's something that you got to purchase separately, right? Yeah. And it can get complicated, but like you said, just keep things simple. We talked about moving averages. If you're a watcher of this and you don't know what a moving average is, then it's just simply the average of the last number of days, and it just smooths out the curve, smooths out the price, right? So generally, when a short term, crosses over a longer term one, it'll indicate maybe that the price is about to fall, and then when the short term goes above the longer term one, it'll indicate the price is slightly going up. But obviously, do your own research around moving averages. I see a lot of experts always using moving averages. Probably one of the most popular technical indicators, which we'll get into a little bit further in some of our lessons going forward. But one of the questions I have for you, Jason, I think I get this from a few clients of mine sometimes, when using such strategies, right? How do you choose? I think this goes down to question 1. like we only trade ASX stocks with Self Wealth, right? We have US and we have Hong Kong as well. But how do I choose? Because there's 2,000 stocks, right? How do I choose whether I get in mid caps, small caps, or large caps? Now you've put a filter of 30 and below. I kind of like to go lower than 30, thinking that I'm going to get more growth eventually, right? But how would you choose? What am I? Should I just stick to small caps? Should I just stick to mid caps, or should I just stick to big caps? What's the
Yeah,
how would you choose?
the answer's different for everyone. It really depends what it is that you're trying to achieve. It depends what your risk tolerances are. So the smaller stocks are just not for some people because there can be more volatility, there can be less liquidity. Some people just aren't comfortable, and that's okay. It's a big market, and there are lots of opportunities across all the different sizes. I believe that the smaller caps offer the greater upside potential simply because, like, to become a big company, you've got to the great gains in the share price comes from a small company becoming a big company. And so I think there's more potential for a stock with a market cap of 100 million to rise tenfold in a couple of years than there is for a top 20 company. So that's why my preference is in the small and the mid caps. The small and mid caps also pay dividends, so it's not like we're talking about. Want to also differentiate between speculative 1 cent mining stocks and an emerging ASX industrial business with a market cap of $100 million. They're completely different things, but they're both going to be classed as small at the small end of the market. So people need to decide what's right for them. I look at all the signals that get triggered through my motion trader system that meet the moving average and the breakout criteria. I'll look at everything, but like everyone, I don't have unlimited capital. I can't invest in everything. So for me, it's just about when I've got available capital, it's like, well, what's triggering a signal now? And then look to move capital into that, and just accept that, like, there are so many opportunities that I can't invest in, not just in Australia, but in the US, in commodity markets and the currency markets. I'm always seeing chart patterns and setups. I go, geez, that looks interesting, but you can't be in everything, and that's okay. You don't need to be in everything. It's about having a criteria that shows the potential for gain, and then just following that over time, and accept that I accepted a long time ago that there's a lot of stuff which I won't be able to buy because I'm fully invested elsewhere, and that's okay. And then as things roll off, go into new emerging opportunities. And but everyone has to make their own individual call what's right for them, because what's right for me won't be right for you, won't be right for somebody else, and vice versa all the way through.
Yeah, I think that's exactly right. And, I hear it time and time again, right? Stick to one asset class. If you're a trader, try and stick to one asset class and master that asset class, or master a section of that asset class. Yet we always want to do everything and we want to trade everything, right? So the important thing is trying to stick to it. All right, we've got some questions in the audience. Jason, here's Shannon. What are your thoughts on using the ATR as an exit point? 4 times ATR.
4 times ATR. It's that would probably be like a shorter term approach, using a 4 ATR. So what I do with Motion Trader, I'm using a wider trailing stop. I might use like a 10 ATR, and because I'm looking for stocks that might trend higher over the next 1 to 2 years. And if you look at a chart of a stock that rises over 2 years, it's probably going to have a series of double-digit pullbacks. They could be like 20, 25, even 30%. A 4 ATR stop won't be able to see off a 20% pullback, most unlikely, whereas a 10 ATR can. So if you're looking for you're a swing trader and you're looking for a move maybe over the next month or two, maybe that's appropriate. It's just explain what an ATR stop is, I guess, by the way, for people who don't know. It's just using the average trading range of a stock and adjusting your trailing stop by the volatility of the stock. So if it's a volatile stock, your 4 times ATR stop will be further away. If it's a low volatility stock, only trades in a small range each day, the 4 ATR stop might be quite close. So it kind of tailors the stop to the situation. So it can be quite an effective way of transitioning from the more volatile stocks to the less volatile, as opposed to using a stock standard 20% for everything. So I think ATRs are a really good approach. What distance you're going to trail your stop, well, that really, you've got to decide what time frame am I after. So I wouldn't say, look, 4 ATR is too close. I think it's too close if you're trying to trade a medium-term trend that could run for 2 years. But if you're trying to trade a move that might run for 2 months, maybe that's the mark. In that case, the 10 ATR is probably too big. So it's got to be right for the situation. Fit for purpose is pretty much how it goes.
Yeah. And can you test the ATR in that trading block software? Can you test that just for?
Yeah, absolutely. Trading blocks is great in that anything you can kind of think of, you can test. But it's complicated software. It's not going to be for most people. Most people don't need to go out and buy high-end trading software to work out what works for them. You just got to do a bit of research, find stuff. But it's trading blocks works for me because I've spent the time to go through and build and construct and understand it. But it's not going to be for everyone. But I think most system software would allow you to backtest a simple ATR trailing stop. It's nothing, no rocket science in an ATR stop loss. It's about as clear cut as you can get.
Yeah, and I know you can download. You can go on TradingView and you can get indicators that show the average trading range, and you can adjust it, and you can obviously check it out and see how it can work over time on TradingView. Just as I use that 25% stop loss for most of my stocks as well. And I know you can actually download an indicator which shows it actually follows. So 25% follows wherever you buy it from, it'll follow it along. So if ever the price were to drop below that line, I can also set an alert in TradingView, which I didn't do, and I'd lost out on some profits there. So just as a tip, guys, if you use the free software TradingView, right, you can definitely set an ATR, or you can set a percentage stop using some of the indicators there, and also set an alert for if a stock closes below the price, right? So and was the shorter? I got James asking, was the shorter averages strategy less profitable than the 50/100?
Yeah, it's no, it wasn't. But just to stress, so this was a really simple back test which I put together quickly. It's not using a trailing stop. It was just for the sake of doing a demonstration of how system software can work and just testing a dual moving average. The biggest issue from the testing we did was the number of trades that the 20 and 30 day produced. So the profitability was slightly less, but there was I think it was 3 times as many trades. So you have a cost factor with that. It's also and a lot more active. You've got to have the time then to do it. So some people have lots of time to focus on the market all day, others don't. So if you're busy with something other work, maybe you've got to look at strategies which do use longer moving average, which create less activity. But James, no, the 50-100 day in that simple example produced a slightly better result, but with a lot less activity. And I can see just the question underneath it, like how does this strategy work against buy and hold ASX 200? Well, look, I'm not advocating that strategy we use, the dual moving average, as being a standalone strategy. Again, very simple. It turns out that over that 4.5 year period, the 50-100 day strategy was up something like 80% overall. The All Ordinaries was up something about 30% over the period. ASX 200, pretty similar. So in that situation, it's outperformed. But that's not to say you should just go out and use dual moving averages and you'll outperform the market. It's very simple analysis, and it was more to demonstrate than to say they're the strategies to use. But I do think for someone who's prepared to actively manage a portfolio, I think there definitely is the potential to outperform the ASX 200 over time. And I look at my own portfolio, and I've been running a live portfolio using my motion trader approach since September 2015, and I've comfortably outperformed the ASX 200. Not during every not month in, month out. There are months when the ASX does better, but by following that rules-based systematic approach over time, it gives the potential to let profitable trades run, cut losing trades relatively early, and it's kind of like an active management style. You're kind of aiming to cherry pick the best parts of the market. Like within any rising market, you'll have stocks that are going up, going sideways, going down. So we want to cherry pick the ones which are going up and will potentially continue going up, and avoid those that are going down and sideways. And when we get into one which is going up and starts to go down, well, we want to rotate out of that and get into something else. So that's where you get that potential to outperform, buy and hold. But you've got to have the right processes. You've got to have good rules. You've got to have the consistency and discipline to follow the rules. And this is where a lot of people fall down. They'll follow the rules when the market's rising, but then we'll have a downturn and they'll stop following the rules and say it doesn't work anymore. And then after a period of time, it starts working again, but they've missed out because they didn't think it worked anymore. Then they don't want to follow it because they say, oh, well, I've missed it. And the whole thing just doesn't work. So you've got to have that consistency to follow it over time as well. And that's where I think that's one of the mistakes a lot of people make, and why things often don't work out for people.
Yeah. And we got Hannah. Hannah's asked, wouldn't something else rather than moving average possibly give you better entry signals? I think that's a question similar to like how long's a piece of string. It's obviously, we were just giving an example, aren't we, Jason? It's not like
if I was to use, Roger, if you said, Jason, pick one indicator, and that's the only indicator you're ever allowed to use, I'd use a moving average.
Yeah.
It's probably the simplest of the indicators, but I think it's just classically most effective. The elegantly simple approach. It's just what it's doing. I'll buy a stock when it's above a moving average, and I'll avoid a stock when it's below. It's just giving you that big overall filter to get in or get out, and you can adjust the time of the moving average to suit what you want to do. You can use a 20-day moving average or a 100-week moving average. Depends what you want to do. It's but you want to. It's all geared around going with the trend. It's a trend following indicator.
Yeah.
And if you're a value investor, it works as well. So you find a stock that you think offers great value, but it's below the moving averages. Well, maybe your timing's not right. The famed value investor Jeremy Grantham always talked about the curse of the value investor, and that's being too early. But you can help dispel the curse by using a moving average, because you find the great value and you wait for the price to then get above the moving average, and then potentially you're on the upswing then, rather than buying as a stock is declining below the moving averages. So it can be used by fundamental investors and technical alike. And there's no holy grail when it comes to entries. There's all sorts of indicators, but nothing's magic. Nothing works all the time. Everything's prone to false signals. Whether you're using fundamental, you can be a great fundamental investor, but you just call it wrong. So nothing's perfect. So looking for perfection I think it's a fruitless task.
No, but at the end of the day, this is what we're here for now. This is the stuff that a lot of people are out there trading on technical indicators, right? Which is great, because we're going to have more of these discussions going forward in the coming weeks about other indicators. And like someone comments there, you're right. Most of indicators are lagging indicators, right? It's all based off price that's already happened in the past, right? So, and there's some good comments there about stop losses, fibs, and Fibonacci retracements, which I know you use a lot in your analysis, but we'll definitely be getting into how to use them in future sessions as well, which I'm really looking forward to.
And Hannah's right. Moving averages are a lagging indicator, but it's really, I guess it's like, nothing. Well, what's a future indicator? Everything I guess has to be lagging. You read a company report, and the company report's a lagging indicator because it's telling you about what's happened. So there's nothing nothing tells us what's going to happen. It's all about how do we use those lagging indicators to try and identify possibilities for the future, and how do we use those indicators to identify what those possibilities might look like, and then how do we manage risk around them. So I guess that's what we're trying to do. We're not trying to, when we use technical analysis, or when I do anyway, I'm not trying to predict the future. I'm not trying to say, I predict this time next month the market will be here, because I don't know. But I'm looking at how it's currently set up, where the price is in relation to the moving averages, and going, I think on balance of probability, my base case would be that we're trading above the averages. So I'll stay with that trend. So I think in a month's time, the possibility is it will be higher. And some people hate it when I talk about that talk like that. They say, oh, you say the market might go up, it might go down. And well, I'll give you the tip. That's kind of how it could go, because no one knows. So it's like, understand the possibilities and manage the risk accordingly. I think that's the best way we can play the game.
Yeah, the game of probabilities, that is. And I agree with Hannah there. A big respect to Jason. He's one of the most generous men I know in terms of his time and his knowledge, right? So looking forward to going ahead with these series, obviously, every week. Thanks, Jason, for your time today once again. Don't forget to like and subscribe on these videos. Go visit Jason and his site, which is Motion Trader. You can just Google that, or you can go on YouTube, Motion Trader. You can see his stuff on. He does weekly technical analysis videos on a market overview as well, which are really insightful and really great. And if you haven't signed up or haven't had a look at Self Wealth, obviously check out Self Wealth and check the link down underneath the video and grab yourself 10 free trades there as well if you sign up. The last thing I should say, obviously, any ideas we've mentioned on these videos are not personal advice. They're not, it's just all just giving people education. They're for educational purposes only. So please don't go out there and buy them based off what we say. Do your own due diligence, obviously, as it's the most important thing when it comes to these educational videos, right? So, yeah. Exactly right, Michael. Use indicators to improve possibility of determining a high percentage of price action. Fantastic. All right, guys. Thanks, Jason.
Roger, been fun as always. Yeah, everyone, thank you for joining in. It's been terrific having you with us, and look forward to coming back and having another chat with everyone next week.
I'll be excited for next week. Take care. See everyone. Bye-bye.